There are a few movie scenes that are unexpectedly as heartbreaking as the scene in Castaway where Chuck Noland, played by Tom Hanks, watches his volleyball named Wilson slowly drift out to sea as he cries,
Wilson! I'm sorry! I'm sorry, Wilson! Wilson, I'm sorry!
Castaway is a vivid illustration of Maslow's hierarchy of needs, which illustrates 5 basic human needs, each one of them building on top of the other. At the bottom of the pyramid, you have physiological needs. Once those needs are met, you move up to safety needs, then up to love and belonging. Once those are achieved, moving up to esteem, and finally at the top of the triangle, self-actualization, which is the desire to become the most one can be. We can reframe Maslow's hierarchy to apply to not just psychology, but also to finances. Let's call this DCM's hierarchy of retirement income. If you're already retired, this triangle applies to you. And if you're not retired, this is obviously something that you're still working towards. But for the purpose of this video, we're going to talk about this in the context of either current or future retirement income. At the base of the triangle, we have 4 and 5, and these represent your basic human needs. Things that you absolutely have to spend money on. And if you had to cut everything else, you would still have to have these basic expenses. These are things like housing, food, water, and then moving up a bit, we'd have things like healthcare and personal safety. And since these things are basic human necessities, we want to make sure to match them with retirement income sources that are also either guaranteed or virtually guaranteed. So the income sources that appropriately match these particular needs would be things like Social Security, pensions if you have one from your employer, or they could be interest generated by fixed income strategies, such as our preservation of capital. The purpose of these assets is not necessarily to grow your long-term wealth, although they can do that. The main purpose is to protect against poverty. So once these needs are met, that's when we move up to the next category, which is wants. These are expenses that are not necessarily essential, but they are desirable. Things that support relationships, like vacations. This can also include some conveniences. Anything that really adds to your life, but is not necessarily an essential. So these items could be cut out if you needed to. These wants are perfect for dividend income. Dividend income is much more predictable than relying on price increases. However, it's not guaranteed. So it's not as appropriate for needs as pension, fixed income, or Social Security, but it's also a lot more reliable than price increases. Not only that, but dividend income tends to increase over time at or above the rate of inflation. So that means your spending on wants can steadily increase over time as the dividend income continues to grow. Further, this rising stream of dividend income also tends to lead to predictable price growth. So, for example, if the dividend income of a portfolio were to increase by, say, 20%, we would expect the prices to naturally increase as well. A rising income source from any asset, whether that's stocks, real estate, or something else, naturally leads to that asset increasing in value. Finally, at the top of the pyramid, we have what we call legacy. The legacy bucket is where we start to think about ways we can make other people's lives better. So this could mean leaving an inheritance to your kids or grandkids. This could be providing education for others. This could be making a donation to a charity. So once needs and wants are both covered, that's when we start to think about the legacy bucket. And this is where we found that our previous investment mix was lacking. We had strategies like preservation of capital, cornerstone, income builder, and capital builder that focused on meeting needs and wants, but when it came to legacy, we didn't have a strategy that fit that particular need. Many of our clients were looking for something that would be a more aggressive total return strategy that would focus more on this aspirational wealth. So we decided to build a strategy from the ground up. In May of 2021, we launched this strategy, which ultimately became known as Sequoia. The stated goal of Sequoia is to outperform the S&P 500 net of fees over the long term. So while Cornerstone and our other strategies focus on security first and then income or growth in different orders, Sequoia focuses on growth first above both security and income. At its core, Sequoia shares the same philosophical roots as our other strategies, but in one key difference. Sequoia is entirely managed quantitatively. We designed an algorithm, which we call CAMP, and we'll talk more about that in the next couple of minutes, but whenever a stock scores highest on the CAMP scores, it gets added to or remains in the portfolio, so long as it is in our investable universe. Speaking of investable universe, that is a critical part of any investment strategy. For example, in Cornerstone, our investable universe are companies that have paid and increased their dividend over time, who also have strong balance sheet, and we believe have a strong likelihood of continuing to raise their dividend in the future. Sequoia's investable universe is a list of the top 50 stocks ranked by hedge fund conviction. We define this high conviction as the hedge fund owning a significant portion of their portfolio in this particular stock. And then from there, we apply our proprietary CAMP algorithm to select the top 20 scoring stocks. The CAMP score is split up into three main categories, starting with competitive advantage, which makes up 40% of the formula. The hallmark of all great businesses, whether public or private, is having some kind of unique competitive edge over their competition. This allows them to earn above average returns on investment relative to what a new startup or one of their competition could do. In Cornerstone, we believe the bulk of our investable universe does have a competitive advantage. Consider that there are about 6,000 stocks in the United States exchanges, and of that 6,000, only 66 have increased their dividend for 25 or more consecutive years. So being able to do something that 99% of businesses fail to achieve seems to suggest they have some kind of rare business trait that could be something like a unique product or service, maybe excellent leadership or a very strong culture. Something allows them to do what most businesses are not able to do. For Sequoia, we don't use dividends, we use our own formula to estimate the strength of a company's competitive advantage. The second part of Sequoia's scoring system is momentum, which also makes up 40% of the algorithm. Newton's first law of motion tells us that an object in motion will tend to stay in motion unless it's acted on by an outside force. Stocks also tend to follow similar patterns. Decades of research has shown that the best performing stocks over the last 6 to 12 months will tend to be the best performing stocks over the next 6 to 12 months. The same thing applies to fundamental momentum, for example, the increase in earnings. Companies that are rapidly increasing earnings and beating market expectations are more likely to continue doing that in the future. So while competitive advantage tends to drive stocks over the long term, momentum tends to drive stocks over the short to medium term. And finally, we have predictability, which makes up 20% of the algorithm. In his book, The Hidden Power of Rising Dividends, Greg Donaldson talks about when he first discovered using regression analysis, which we still use today. In early 1991, Greg was looking for a way to value the Dow Jones Industrial Average. To do that, he built a statistical model that combined dividends and interest rates to estimate the current fair value of the Dow. While the variables and techniques of those models have changed over time, we still use the core principles of those models today. Sequoia considers the output of these models, specifically looking at the predictability of the price and fundamental increases over the long term. Companies that have both prices and fundamentals moving together tend to have a high predictability score, which is 20% of Sequoia's algorithm. It can be helpful to think through your different income sources and expenses within the context of the hierarchy of retirement income. If you find that your wants and your needs are both covered by existing strategies and you want to go for a higher risk, more aggressive, long-term total return strategy to focus on that legacy bucket, Sequoia may be a good fit for you. We would encourage you to chat with your advisor if that's something you might be interested in. And if you're not already a client of Donaldson, you can reach out to us using the email address in the description down below. One of our advisors would love to connect with you and see if some of these strategies may be appropriate for you. Thanks for watching, and we'll see you in the next video.